Have you ever felt like investing is a losing game? Maybe you've made mistakes, like I did, or you're just unsure if you're doing it right. Here's the truth: the average investor underperforms the market, but you don't have to be average. Today, I'm going to reveal 5 critical investing mistakes that cost people, like me, thousands of dollars. And more importantly, how you can avoid these mistakes, learn from them, and build lasting wealth. Welcome back to Dynamics of the Dollar, your go-to channel for mastering your money and building a brighter financial future. Stick around to the end of this video where I'm going to discuss my personal financial mistakes that I've made, and hopefully you can learn from them. Let's go. The first mistake that people make is trying to time the market, trying to predict when to buy or sell based off of market trends or hot tips. Listen, you have to start somewhere. Start with a few dollars here and there, stuff that you're probably not scared to fully lose. Chances are you're not gonna lose it, like historically. But if you're just starting, listen to some friends that have done it in the past, watch videos, listen to podcasts, but learn from what you're doing. You don't need to buy low and sell high. All you have to do is not time the market. Studies show that missing just the top 10 trading days over 20 years can reduce your portfolio's growth by more than half. So basically what that means is instead of buying and selling and buying and selling, just chill. Invest in a few things that you're confident in and invest with money that you're purposefully putting towards investing, and relax. The simple solution here so you don't miss those 10 days, stick with consistent investing.
But how, KG?
The answer is simple, my friend. Automate it. Take the overthinking out of the equation. But even if you're consistent and it's fully automated, could your emotions still be getting in the way? Which brings me to mistake number 2, emotional investing. The mistake here is letting your fear or your greed dictate your decisions. For example, panic selling during a market dip or overinvesting in a bubble. By letting your emotions take over here, you're risking the chance of missing a great buying day or selling on a bad day. The impact here is that the Dalbar study reveals that the average investors earn significantly less than market returns due to emotional buying and selling. Pause. If you know you're emotional, I feel like the people that are emotional probably wouldn't be the first to admit it, and me just saying this made them release an audible gasp. Take your emotions out of investing and just stick to a very simple plan. Have a goal in mind. My goal: to quit my job one day, retire early. The solution here is to have a clear plan. Set rules for when you go in to rebalance your portfolio, and make sure it's based on logic, not emotion. There's a quote by Warren Buffett that says, "Be greedy when others are fearful, and fearful when others are greedy." Now, if emotion isn't the problem, could it be your choice of investments? Which brings me to mistake number 3, lack of diversification. Putting all of your money into a single stock or sector or asset type. It goes back to that saying, putting all your eggs in one basket. So if you're carrying like a dozen eggs and you drop the basket, you have no eggs. My advice: invest in all of the things: real estate, stocks, ETFs, crypto. Sprinkle a little bit of everything, and you'll see that diversification will help you so much. Some of the stuff will be going up one day, something will be going down, but at least it's not all going down at once. So diversify. In 2022, tech-heavy portfolios saw dramatic losses, proving that even a hot sector can fail. That was probably a big reason why I was leaning on it. The solution here is simple: diversify across sectors, different assets, stocks, bonds, real estate. Keep things balanced.
Perfectly balanced, as all things should be.
Over a long period of time, this will be the game changer for you. Trust me. Now you're fully diversified. But is it too late? Mistake number 4, not starting early enough. Delaying investing because you don't think you've earned enough, or you're waiting for the right time, will money you up. Man, what I would do if I could turn back the clock to my early 20s. I didn't start until I was 27, 28 years old, But that's when I was making those very early mistakes that I should have been making in my late teens or early 20s. Basically, I just wish I learned from those mistakes earlier. So this part of the video is really for either those that have not started yet, or for the young ones that are watching this, 20 years old. Trust me, start. Someone who invests $100 from age 20 to 30 will likely end up with more wealth than someone who invests the same $100 between the ages 30 and 60. Start now, even if it's small contributions. $5 a paycheck, you can spare that much. Trust me, just start. Compound interest will change your mind about investing. So which of these mistakes are you making? And what can you do about it today? Investing doesn't have to feel like you're sitting at the back of the short bus. By avoiding these 4 mistakes: timing the market, emotional investing, lack of diversification, and not starting early enough, you'll set yourself up for financial success. Now, for you beautiful bunch of people that have stuck around to the end of this video, thank you. Now here's my story in a nutshell that I hope you can learn from. I invested small pocket change for 2 years. In those 2 years, I saw almost no gains at all, mainly because the fees outweighed what I actually got back, but also because I wasn't willing to take more risk, which I highly recommend if you're a little bit younger, taking more risks. I took all that money out when it was around 2K, and I just started investing it myself. And here's where I thought I was so financially cool. I thought I was a G. I was buying and selling, buying and selling. And in all of that chaos, I lost around $2,000. I was still contributing to it, but it wasn't good. After that, I spent the next 4 years just automating my financial process and thinking long term and taking all of the emotion out of it. Yes, I'll read articles, yes, I'll read books on it, but I try to just stick to my plan with a little piece of my investment going towards things that I like to call investment money. Now, after years of digging myself out of that hole, I'm finally in the green. And now I'm on pace to retire early, baby. So trust me, avoid these mistakes, start early, subscribe, please, and I'll see you next week.